Welcome to another episode of Equity Mates, a podcast that follows our journey of investing. Whether you're an absolute beginner or approaching Warren Buffett status, our aim is to help break down your barriers from beginning to dividend. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. We're playing a bit of an away game today.
Yes, we're not on our home ground.
We're in the away studio.
Yes.
And we're also wearing our away jersey.
I'm kind of loving it. Yeah, it's giving me some good vibes.
For people listening, not watching on YouTube, Bryce is wearing a party shirt with fairy bread. Yeah. And I'm wearing one with ice creams.
Ice creams.
And the reason that we're doing that is because there's one person who is trying to pioneer the finance party shirt, and we're in his studio.
Yes, we are. We're in none other than Rask Australia's studio, and we are joined by Owen Raskovich. Owen, welcome.
G'day guys, great to be here. Yeah, loving the shirts, digging it. It's
Where's
great.
yours?
I've been told. I got the Stern talking to. Make it Rask branded. But yeah, don't worry, that'll be coming out straight after this.
Great. Now, if you have joined us for the first time here at Equity Mates, welcome. Great to have you as part of the community. We have created a course with Owen that we launched last year called the Value Investor Program. And it is the second course we've done. The first is a Get Started Investing course. And this Value Investor Program, or VIP program, Ren,
See what we've done there?
Yes. Is a course designed if you want to take that next level or next stage of investing and understand valuation of companies. Mm. And over the next 3 episodes, we thought, why not actually put this course to use and do a couple of case studies using some of the information and the tools and resources and lessons in the course. And Owen is going to be guiding us along the way.
Yeah, valuing a company is definitely like the last hurdle, like the final boss, the last domino to fall, whatever metaphor you want to use. Like that, you can learn so much about investing, but actually understanding, getting your head around how to value a company, I think, is the biggest challenge for most people. Luckily, Bryce and I don't have to explain it because you're here, Owen. But let's start general and then we'll get specific. Actually, we should say, this is a 3-part series. This episode, we're going to be talking about value investing and methods of valuation. And then the next 2 episodes, we're going to actually be taking Owen's laptop, looking in his files and going through 2 valuations he's done. One on Australian company Xero and one on US company, you may have heard of it, Apple.
Love it. Cannot wait for that. So, Owen, let's start with the fundamentals. For someone who's just joined and thinking, what on earth are these guys talking about? What is value investing?
Yeah, cool. So there are obviously different forms of investing. If we just take probably the 2 most common, you've got value investing and you've got technical analysis, which is where people look at charts and they talk about trading. The key concept and the thing to understand is that with value investing, we believe that the share price doesn't match what the value of that share is. So this would be like if you walk into a Nike store and you think, those pair of shoes, it says $100 on the ticket, that's the price, but maybe you think they're worth $150, so you buy them. So that's the undervalue. Now, with technical analysis, which is the other side of the coin, in that they assume that the price represents all of the known information. And so that price is an accurate reflection of the value. So there's no difference. But with value investing, therefore, you could say that if you have a better view on the true value of a stock or a true value of a company, that you could exploit that, right? So if you think something is worth more than the share price, that's something that you should be looking at buying. And so that's the basic principle. And obviously the likes of Warren Buffett and many of the investors that have gone after him, Charlie Munger, many of these famous investors have popularized this. Then you take lessons from those guys and you bring them forward into the modern era. I know you guys have had people like Joe Mager on the show. Yeah. He comes from the US and spent a long time in Australia, and he really introduced this idea that value investing is not so much about spreadsheets. It's actually about qualitative investing. So what I mean by that is, in order to get numbers in the balance sheet, in the profit and loss statement, there's a business. So you've got to understand that business and how things get on there. And by doing that, you can actually get in front of the value and you can try and estimate what a company is worth.
Mm. No, I think there's an important distinction here because you just said there's 2 types of investing: technical analysis, where you believe the price reflects reality, I guess, and value investing where the price does not reflect reality. But people often hear about the distinction between value and growth. So, but you're grouping both of them under value. So just explain that for people.
Yeah, sure. So this is, in finance, we love to put people in camps. There's growth investors, there's technical analysts, there's fundamental analysts, there's all these different words that basically all mean the same thing, because we just want growth and we want, income. Those are the only reasons you invest in anything. When you think about it, doesn't matter if it's a property, doesn't matter if it's cryptocurrency, you want something from that investment. And so growth is this kind of idea that the value of a company can go up over time. So notice how I said value of a company can go up over time. Now, some people confuse that with the share price going up. And that may be true. Like, you might buy a share, say, of like Commonwealth Bank for $100 and you sell it for $120 6 months later. And that sounds like growth because it's going up, right? But when we talk about growth investing for long term, it actually is indistinguishable from value investing, because what we're talking about is the value going up over time, the company building things, doing things. And maybe it's not 6 months, maybe it's many years. And so it's a key distinction. I was on the TV not too long ago, and someone challenged me. They said, there's a company on the ASX called Rural Funds Group, which is just it's like a trust that owns property, like agricultural property. And I was like, this is not a growth stock in the traditional sense. And the other expert on the show said, oh, well, I beg to differ. It went up 20% in the last 3 months. And I was like, no, that's just the share price moving around. Like, it doesn't actually reflect the value. So value investing kind of encompasses all of that. And I think people get parochial and they tend to get really tribal about, no, I'm a growth investor, I'm a value investor. The same thing, just we all want the same thing at the end of the day. And if you believe in the tenets of value investing, then you can do it any way you like.
To give like a real, like maybe a bit more of a specific example, a company like Zoom that's growing its revenue at, I don't know what it grew through the pandemic, call it 50% a year or something, or a company like CBA that's growing at 3% a year. One might be considered a value play, one might be considered a growth play, but at its core, you still have to value the business, and then you invest when you think the market is undervaluing the business.
Exactly. Yeah, great examples. And and then it depends on your time frame, right? Like with Zoom went from, I can't remember the exact share price, but it basically went up like fourfold during the COVID pandemic, and then it came crashing back down. So if you had a 5-year window, you'd say, oh, maybe it's a growth stock. But then if you took, a 6 month or a 12-month view, then maybe it's like a rapid growth stock. Maybe if you'd go 10 years, who knows where Zoom is in 10 years? Maybe it's not a growth stock at all. Maybe it's, in decline. Mm-hmm. And that's where you've got to do that fundamental analysis, that follow the value investing principles to determine that.
So we all like investing in different things. Ren loves mining small caps.
I love losing money.
Loves losing money. Others love crypto. Others love the top end of the market, which is your CBAs, your blue chips.
Yep.
Who loves that?
You do. You love it all. Does this valuation approach apply and work across the board? Or how do you think about this when you do segment the different types of markets and I guess asset classes as well?
Yeah, sure. So we're going to show some examples in the next 2 episodes. But I would say that when you're investing in earlier stage companies, like companies that maybe are not profitable, but they've got sales and they're growing, you can value them using simple, heuristics like the price to sales multiple, which is where you just get the share price or the stock price and you divide it by the sales per share. And you can look at that in the early stage and you can say, well, revenue is really important for this company. It's really early, so it's not actually creating a profit, but there is a way that I can kind of put a yardstick in and say, okay, it's here at this day. I think it's going to be over there in a couple of years. But then when the business matures, you can see more of the fundamentals. And what I mean by that is like on the financial statements, when you're in the annual report, you can see more of the money falling down the income statement. So at the top, you've got sales and revenue, then you've got costs, and then you have expenses like marketing and admin and all that sort of stuff, like offices and whatever. And as a company matures, you can see the money basically dripping further and further down the income statement until eventually it becomes a profit. And that's when a business, is inflecting and it's hitting maturity. And so depending on the stage of the company, that we use different principles. So we'll talk about, for example, Apple. With that company, you probably want to use a discounted cash flow, but it's also you can also use just the simple price to sales if you want to do that. With Xero, which does not have a profit, it's a bit harder to do a DCF, and it's very much harder to do like a price to earnings, or that's just basically a price to profit multiple. And so different companies require different, tools. Some people do have one favored tool. Like it's clear around the world that discounted cash flow or DCF analysis is the most popular.
And what about things like ETFs, cryptocurrency, venture or private investments? Like how if someone's sitting there going, yeah, I want to understand valuation, I want to apply it to these parts of my investing as well.
Yeah, I know you guys have had the likes of Nikki Shivak on the show, Australia's best venture capitalist. Yeah. And, if you ask someone like that who's investing at the very beginning of Canva, like when it was even pre-revenue, didn't even have anything, just had an idea.
Nice.
Yeah. Oh, that would be good. so you look at that, right? And you go, well, how could you possibly think of how do you decide if it's good value or not? And basically you're just backing the idea at that stage. And so what tends to happen in the venture capital world is it's not necessarily based on cash flows and profitability and all that. Of course, that one may be based on an idea, but the way value is constructed in that environment is actually more like a after the fact. So these founders would go around and try and get money in for their business, and they would say, I want to sell 10% for $100,000. So 10%, $100,000 means the whole thing's worth $1 million. Right? Now, the next round, they might go, we want $1 million and we're selling 10%. Now it's worth 10 million. And so you can see how the implied value, because what's happening in that instance is it's basically just who's going to give us money at what valuation. And that becomes the valuation. The market is the valuation. Whereas in the stock market, we can actually see prices and value deviating when we have a valuation in play. But cryptocurrency, if I just answer that separately, that doesn't produce income. So you're limited in your tool set. You can stake and do things like that, but for the most part, you require a different set of tools. And there's academic theory around how you can do that. And basically, it goes back to this thing called, I don't want to geek out too much, but it's called arbitrage pricing theory. And what it basically means is you have a different set of outcomes, and can you exploit that?
Now, Bryce also mentioned ETFs.
Oh yes, ETFs.
That's probably one that a lot of people do invest in. How are you doing that?
Well, this is a bit of a black box globally. So ETFs, if you think about what an ETF is designed to do, for most people in a traditional ETF, so I'm not talking about those crazy thematic or inverse leverage ETFs, that type of stuff. For those, you can go to the website and you can look at it, it'll say average PE ratio, or it will say average price of sales or average size of the companies inside it or whatever. Now you can actually use that. I don't do this as much in practice, but you can actually use that to determine a valuation, because if you think about any investment, you put money into it, you get some money back, hopefully, hopefully more than you put in. And if you think about that, you can take the price of the ETF as a whole and think, what dividends am I going to get from this thing? And so you can use those dividends as a cash flow stream, and you can value that. And that's just, we use that, we call that the dividend discount model, or DDM. It's very simple. It's basically, what's the value of those dividends, and what risk rating am I assuming? It's actually quite simple, and we cover that in the course. We don't cover ETFs in general because, for the most part, what we're talking about today, I just want to be clear, maybe I should have said this at the outset, is that most investing and most people who listen to this never need to become value investors. The simple fact is you don't need to. This is for the people that are truly curious about how businesses and how industries operate. But if you just want to invest in a passive ETF, don't even worry about it. You can use different rules like Shiller's PE.
Shiller Cape.
And you can do those types of things where you get a PE of the whole sector and the whole industry. We see that with asset consultants, but for the most part, you don't need to worry.
Love that.
So let's turn to individual stocks. The most common is a discounted cash flow.
Yep.
Now, a lot of people will probably be familiar with the term, but for people who aren't, give us the 25 words or less. What is it?
Yeah, sure. So it's the future value that is of cash that's created in today's dollars. So you have a cash flow stream that's expected in the future. You just put that in today's dollars. So, that whole thing with the kid and the ice cream, if you promise them one ice cream today or two tomorrow, they'll take the one today. That emphasizes that the value of something today is worth more than it is tomorrow. And that's basically what we do with cash flows, is we try and take what's expected in the future and we get that today. And there are multiple different ways to do it. It sounds really complicated, but there are many ways you can do it with even just a few lines in a spreadsheet or even just on a piece of paper.
Without going into specifics, because I'm sure we will do it in a bit of detail when we do Xero and Apple, but what are some of the positives about a DCF and perhaps some of the negatives or weaknesses as to why you might not use that as a valuation method?
Yeah, sure. So the first thing is you obviously need to determine what is the cash flow of the business. And so that's often different to profit. So with zero, which we can talk to a little bit in the next episode, but with that, you have to kind of assume some things. You have to guess, basically. So a lot of valuation when it comes to the future is just educated guesswork. But there's other things, and I think the best analogy is that when you're in a spreadsheet and you're valuing companies, if you make one wrong move, it's kind of like programming. If you like miss a comma or something, the whole thing can just break. And so what happens is, the best analogy is, it's like the Hubble telescope. If you might move one thing 1 millimeter, you're looking at a different galaxy, right? And so when it comes to valuation, it's much the same in that if you change like what we call the discount rate, or like the risk rating, if you change that by like 1%, you could be looking at overvalued versus undervalued. And so it's very sensitive. So we have to build tools into it to make sure it's not as sensitive.
So that reminds me, we were speaking to an expert late last year, Ricky Sandler from the States, and he said a quote that was, "Valuation is an opinion." So I wanted to get your thoughts, because, a lot of this is theory and spreadsheets, and it feels like that if you do it, you get to the right answer. Yeah. But is there such a thing in valuation, in your opinion?
I would say that's probably the most succinct thing I've heard, to be honest, about value investing, is that there's no one right answer. And all three of us could have the same set of information in front of us and come up with completely different answers. And that's because you guys spend a lot of time talking about this on the show, is like people's investment philosophy and how they approach things. And that's actually built on people's education and experience. So if you have a different set of, experiences, and you come at it in a different way, we might both be looking at the same company or industry. So we might look at, say, Seek, which is the HR website. And you guys might have had a really good experience with that in the past, and you think, oh, it's a great service. And I might have had a really bad experience with that and think, oh, there's going to be someone that disrupts this for sure. We have the same set of information, but we have different opinions about the quality of that franchise or that business. And so absolutely, what we're doing in a spreadsheet is basically just wrapping maths around an opinion. And that's it.
And I think that's the key thing. People often think the hard thing about discounted cash flows is what's in the spreadsheet. But that is the easy part of the job. The hard part is predicting the future outcomes for a business, figuring out the range of outcomes, and then figuring out the probability of each outcome coming through. And so, to go back to what you were saying earlier about Joe Mager, it's like you need to understand the business and where it's going, and predicting the future is hard. Doing the maths, once you understand it, is actually quite straightforward.
Yeah, absolutely. So, how I said before about valuing an ETF, you can use a dividend discount model. That only takes 3 inputs. It just takes the dividend, how fast you expect the dividend to go, and your expected return. So like what you want from the investment. There are only 3 things. And that's a really simple illustration of, the tool.
Now, if you're worried that this all seems too complicated and you're not going to be able to get it, have no fear. A lot of experts don't get it. And this introduces Bryce's Man of the Year in 2022, that Carvana analyst over in the US.
Yes. The guy who worked for Morgan Stanley. Was it Morgan Stanley? Yeah, one of the big investments. I know it wasn't JP, and I've forgotten his name. Someone who, in a matter of 12 months or so, said that his valuation on Carvana was $420 a share. Then a year later, when it's plummeted, he said there is a very high probability that this is valued at $1. So
valuation is an opinion.
Tell me how that works.
Yeah, well, I guess I can tell you how it works, and that's basically recency bias, right? So that's someone that's taken some information from right now, and they've gone, this thing is going to go to the moon, and then reality sets in, and this thing is obviously very fickle. The business itself is very sensitive to changes in the economy and whatever, and recency bias turns that around and says, what happened in the immediate past is actually not a fair representation of the future. And that you see that all the time. Yeah.
And the maths wasn't the challenge for this guy. He might have got his spreadsheets wrong, but it was accurately forecasting what Carvana's future was. Yeah. So this isn't so much a maths problem. And we'll get to that when we talk about Xero and Apple in the next 2 episodes. What Bryce and I will be stress testing Owen on is his assumptions about Xero's future. And you will be stressed.
So we've spoken about DCF, which is probably one of the most common methods of valuation across most companies. But you also hear ratio, time and time again.
Yeah, PE, PEG.
Yeah. So where does that come in to valuing companies and potentially the difference between using that versus a DCF?
I think so. There are many great investors that use these, what we call multiples, like it's just a multiple of this or a multiple of that. At the end of the day, you can use these in one of two ways. The most common way is just to take the ratio or the multiple and say, oh, well, this company's at a PE of 10, price earnings ratio or price to profit. That's the comparison. And you say, I think it could be worth 15. So if it goes from 10 to 15, what you're getting an increase in the valuation. So that's not necessarily the E or the earnings growing. It's just saying, I think it's worth more. And so people use that as a genuine methodology. There's a great example of this in Australia. There's a guy called John Garrett. He's a fantastic investor. And he basically takes this approach that you get and I'm simplifying it down, but you basically get, say, a sector. Say you want like automotive companies in Australia. And you take ARB, which creates the bull bars and has that red and black logo you see everywhere on four-wheel drives. And you say, okay, this is trading, I don't know, hypothetically at 20 times its profit or earnings. Now, you compare that to the other automobile companies and you go, they're all at 25. Now, does that say that ARB is lesser quality? Because ARB is probably the other way around. So you would maybe then say, no, I think it's worth more because it's a better quality company. And you can compare that. You can use another example. You could say, you could have a multiple, say, of, I don't know, like MYOB versus 0, and you could do a direct comparison. And the final thing you could do is, and this is what a lot of investors do, is they basically take the multiple and then they compare it to the market and they say, is this an above average quality business or is it a below average quality business? And so what I mean by that is like you can go onto like Market Index or any one of like Google Finance or one of these websites, you'll be able to find what's the average PE ratio of every company in the country. Do I think this is better than average? Yes. So if it's below, like if the PE ratio is below, you can buy it. And I wouldn't place a lot of stock in that, but that's a genuine way to do it. The way I use them typically is when you have a discounted cash flow analysis, you use it as a sense check on your modeling.
Yeah, right.
So, Owen, we want to close with how to learn about valuation because I think some people will be overwhelmed by the amount of jargon and stuff we've used. First things first, there is a free Rask Australia times Equity Mates course, Get Started Investing. And then there is a paid one, this Value Investor program. So first port of call, the courses.
Yep.
But there are some other things that you think are valuable when it comes to how to learn about valuation. So where else can we go?
Yeah, I mean, you guys have done these in the past where you talk about like checklists and these are great things. And you can find these online. Like there'll be links, I'm sure, in the show notes to the course and you can get a general outline. I think in Get Started Investing, there's a checklist as well. So what I would say is like using a checklist or just some sort of repeatable process makes a lot of sense. So the earlier you can do this, the better. It's not because it's going to give you the answer. It's just because it will just help you in the sense of giving you a framework to work with that you can then tinker with and improve. So, I mean, there's heaps of these resources on the Rask Education website and in the course. Like in the course itself, in the Value Investor program, we go through, I think it's 43 different points on a checklist. And that might sound overwhelming, but it's literally like, does the company have an aligned management team, or a founder as the boss? And that's a good thing. So you give it a tick, that's positive. So it might add to, +1 for this company. And you can use checklists like this. And eventually what you do is you make the checklist in the first instance, like comfortable for you. And we've talked about circle of competence before, which is like the idea that you invest in things that you know. There's a great picture in the book, Get Started Investing book. It's just investing in the things that you know. And you can design your checklist around that. And that's, like, it could be things like is this company in technology because I'm a software engineer, or is this company in healthcare because I'm a nurse? And you can use that to create your own very simple checklist and just iterate over time. And there's heaps of those free resources online as well as in the course. Yeah.
So you can check out the course. The link will be in the show notes or head to equitymates.com. But I think, Owen, one of the key takeaways for me, for those that may be listening, just joined us, is that you don't need to understand valuation, as you said, to be invested or to get investing. This is for those that really want to understand how businesses operate and get under the hood. But definitely stick around for the next 2 episodes because we're going to be putting a lot of this into action I'm super keen, and I know Ren's got some hot questions for you to really stress test you about valuation metrics. So next episode, we're going to be doing a valuation of Xero, Australian listed company, and then the world's largest company, and that is Apple, in the third episode. So Owen, thank you very much, and Ren will pick it up next week.
Sounds good.
Thanks, guys.